In this video, we're going to be discussing the better way to play USOI, the covered call oil ETF. Yields about 30% in dividends, maybe even north of 30%. I still own USI, but there's a better way to play it to get exposure to high yield, passive income dividend funds without the decay. See, the problem with USOI and a lot of these higher yielding funds is that they decay. And so that's fine if you want to earn your dividends. But if you want to earn this amount of dividends like we're using here, while using margin to get it, which is this number here, this purchasing power, because you get 4 times your dollars for every dollar you put in a brokerage account. If you use this margin power and you get this amount of dividends, then you have to have performance, because if everything's decaying and just going sideways to down like a USOI, then your account will grow, like I've said, steadily over time. You'll cash flow your positions over time. But again, you won't have a big cushion here. This number here needs to have a large enough cushion away from zero so you don't get in margin calls. This number is kind of irrelevant. You need this to have a cushion, and you get this cushion by performance. So, you don't have to use margin to get your dividends, but you have to put all of your money behind something to make a lot of money. And dividends require a lot of money. It takes money to make money, and you have to put, if you have a lot of money, then you can use a dividend strategy without margin. But if you're younger and you don't have much capital starting out and you want to try this dividend strategy, which gives you qualifying income to banks and gives you credit in a way that when it builds qualifying income, you can apply for loans towards a house or a car. So you don't have it's a supplemental paycheck. You don't have to have as much of a paycheck, or you can go entirely into dividends and not have to have any 9 to 5. So margin is the way to get ahead if you don't have any other way to get ahead. And there's no credit check needed. It doesn't show up, as bad debt. You can click sell at any time. So it's good debt, and it's earning me interest over the interest that I'm charged. So why not do it, especially in these high yield dividend funds? You just have to get performance in these high yield dividend funds. And, another way to keep this cushion is to buy low maintenance names. So I'm a big fan of maintenance on this channel, as you know. Performance and value, let me just show you really fast. Performance and value, we're up 19.7% for the year. Dow Jones 0.8, S&P up 8, and the Nasdaq's up 19%. So we're beating the Nasdaq. I told you we would get ahead of the Nasdaq and we would reclaim the lead over it as growth and value started catching up with each other. Remember, our portfolio has been struggling because value has been struggling. See our past video on how to use margin and balancing growth versus value. I wasn't worried about the declines because you need to have a steady balance. And so now we're up, beating the Nasdaq once again. And that's because we, have value, but we use margin. We use margin to stay in the indexes, and that's how you get the performance, and they're low maintenance. So I can use more of my money. Go check out past videos on what maintenance means. But for every $1,000 I put in let's say a cornerstone here that has a 20% yield and it's linked to the indexes, if I put 1,000 in cornerstone, that only takes up 300 of my dollars. If I put 1,000 in USOI, it takes up 1,000 of my dollars. So USOI, I'll just show you really fast the maintenance here. If you look at the snapshot, it's going to show you it's 30% dividend here, 31%, and it has 100% maintenance, whereas other funds have 30% maintenance. So this is crucial in having a margin strategy. So you have to be aware of this maintenance issue. And the other reason why I don't own a lot of USOI is because it's covered calls, so the upside is capped, of course. And all these covered call funds that we own, the upside is capped. So plus, it's covered calls on a volatile industry. So what being oil, so you don't know what the dividend is going to be. The dividend's going to vary. The performance is going to vary in USOI. So we only have, as you can see here, $500 in it, and maybe I'll get that up to 1,000. but it really takes up a lot of equity. As you can see, our margin debt number here has grown to 255. I've had to pay some bills. 255 plus I bought USOI and a little bit of Oxford the other day. See our past video on Oxford. It just had a dividend raise. So our debt is growing a little bit because, like I said, I have bills. And so anyway, USOI, I have a little bit, but I don't think you should have a large amount in it, because if you want to replicate the indexes, the S&P only has energy at about 4% or 5% of its weightings. So you don't want to have more than 4 to 5% of energy in your weightings. And if you go through my energy holdings, you can see that that's about what we're at on a $100,000 portfolio, which I like to keep my portfolio broken into. I keep I don't want to go on a tangent here, but this whole number here, about 400,000, including losses that I'm down in Cornerstone, I break it all into subsections of 100,000s, so I can compartmentalize each section better. And each 100,000 is designed to match the indexes, the S&P and the Nasdaq. If you can just match the indexes, then you're going to perform in line with the indexes and not get surprises to the downside and trigger margin calls. And that's the name of the game. We have to stay away from margin calls, because that's how we live financially free. So anyway, USOI, large dividend. The fund goes sideways. Do I have to show you that on a chart? I don't know. If you want to stick, you can go ahead and click out. I'm sure if you have better things to do, you can. But I'll just show you USOI on the chart. Because I want to show you the decay. It just decays sideways over time. 31%, okay, and it decays over time. So this is not great performance at all. So USOI, I have $500 in it because of this decay, and I put the rest of my money in the indexes. Once again, you have to tie everything to the indexes. There are a lot of high yield dividend names out there that are interesting with really high yields, but you can only have a small amount of them because they usually have high maintenance, or they don't perform with the indexes. They decay. And when the market, that does well for you over time, if you're using margin, you'll do okay. But when the market falls, you won't have enough cushion. You won't build enough cushion from your higher performance, and you'll trigger a margin call. You need to get performance all the time. You don't want to be playing defense to win. You want to play offense. You don't want to play to lose. You want to play to win. So anyway, and then always have your names here that you have identified with high maintenance, so that when the market is falling, you can sell at any time. USOI, I'll sell this at any time. I'm not worried about it. I won't lose much because it's only $500. If I lost 10%, I'd be down $50, and the dividend would have covered it in the meantime. So I can sell all these high maintenance names and release the pressure whenever I need to, whenever we're close to a margin call. So, but we never got close to it, even in 2022. I did get a margin call in 2020 during Corona, but that's because I was tied to energy and real estate. You don't want to do that. You want to be tied to the indexes. So anyway, that'll do it for the video. Keep small amounts in funds like USOI that decay, especially because it's a small percentage of the S&P, and they have high maintenance. All the reasons I just said, keep that in mind. If you have any other ideas of videos you want me to make, leave comments in the section below. Also, email me for e-guides at aikentodd48@gmail.com if you want the margin or cornerstone e-guides. And I'll talk to you soon. Thanks.